Have you ever looked at your mortgage statement and just, well, sighed, wondering how many decades you'll actually be making those payments?
Oh, yeah. It's a feeling I think most homeowners know, that long road stretching out ahead.
Exactly. But what if there was a profoundly different way, a strategy that could, significantly cut down that time?
And save you a really staggering amount of money in the process.
All without needing to suddenly boost your income or anything like that.
Right.
Today, we're embarking on a deep dive into exactly that, a fascinating approach to homeownership that really challenges the traditional mortgage model we all know.
Mm-hmm.
We're drawing insights from a source called Switch U, and they advocate for, well, a paradigm shift in how we manage our biggest debt.
Yeah, a fundamental rethink.
So our mission today is to unpack this strategy. We want to understand the principles behind it.
And really explore how the numbers work. See if they truly add up to what Switch U calls a better way to pay off your home.
It's about demystifying something that might seem complex at first glance.
And showing you the potential for real financial freedom.
No, it's perfectly natural, I think, maybe even expected, to feel a bit skeptical when you first hear claims of massive savings and, paying things off super fast.
Absolutely. Switch U themselves acknowledge that reaction. They suggest the traditional banking system sometimes uses maybe a sense of fear or just inertia to keep people doing things the same old way.
The way we're sort of taught to do it.
Exactly. It becomes the accepted norm, right? But as our source material emphasizes again and again, this isn't magic.
No.
It really is just math. And our goal here is to help you understand that math so you can see if this approach, clicks for you and your goals.
Okay, let's dig into that idea of conformity and the traditional mortgage first. Because the word mortgage itself, it has a literal meaning that, honestly, it's a bit chilling when you hear it.
It really is.
It comes from late Middle English, and it literally means dead pledge.
Dead pledge, wow.
Yeah. Mort, from the Latin, mortuus is meaning dead, and gage meaning pledge.
And what's fascinating, really, is how that sort of ancient, almost ominous term, how it translates into the mechanics of the modern traditional mortgage. Our sources point out that these mortgages are, kind of by design, structured to keep you paying interest for as long as possible.
Right, before you even start making a real dent in the actual principal amount you borrowed.
Exactly. You're typically sold a 15, 20, maybe even a 30-year term.
Mm-hmm.
And you're basically taught to just accept this incredibly long period of debt.
Like it's just the way things are. An unavoidable part of buying a home.
A rite of passage, almost.
So what does this actually mean for you, the homeowner, listening right now?
Well, it means that, often without even realizing it, you could be caught in a financial setup that heavily favors the bank's long-term profit.
Over your own financial freedom. Massively so.
Yeah. When you sign up for decades of paying mostly interest up front, that's how amortization schedules work. You're essentially agreeing to a system where your first years of payments do very little to actually increase your ownership stake in your home.
It's a powerful thing to realize, isn't it, when you think about how much more equity you could be building much sooner.
Definitely.
But what if there really is a demonstrably better way? Our deep dive into Switch U's material, it reveals you can radically change this whole equation by using a home equity line of credit, or a HELOC, as we'll call it from here on out.
A HELOC.
Okay, yeah, using that HELOC to pay off your home in just a fraction of the time.
And importantly, it's not about finding some obscure loophole or gaming the system.
No, not at all.
It's about using a different financial tool, one that just operates under different rules.
Exactly. So this obviously raises the big question, how? How does a HELOC actually achieve this kind of super fast payoff?
Right. Well, the core difference, the real engine behind it, is how the interest is calculated and how you apply your income. So unlike a traditional mortgage with its fixed payments and that amortization schedule that loads interest heavily at the start.
Yeah, the one where you barely touch principal for years.
Precisely. A HELOC typically operates on daily simple interest.
Daily simple interest. What does that mean practically?
It means interest is calculated each day, but only on the actual balance you owe on that specific day, not based on some preset schedule.
Ah, okay.
So when you make a payment, and this is key, that entire amount immediately reduces your principal balance.
The whole payment.
The whole payment, instantly reducing the principal. And because the principal is lower the very next day,
you accrue less interest.
Exactly. Less interest accrues immediately.
Okay, so how does income play into this? Switch U mentions leveraging 100% of your income.
Yeah, this is the other crucial part of the strategy they advocate. Instead of your paycheck landing in a separate checking account, and then you pull out a smaller fixed amount for your mortgage payment.
Right, the usual way.
With this HELOC strategy, you direct your entire income, your whole paycheck, directly into the HELOC.
Straight into the line of credit.
Straight in. Which immediately, drastically pays down the principal balance. Then you use that same HELOC, like a checking account. You pay your bills, buy groceries, all your normal expenses out of it.
So money flows in, pays down principal, then flows out for expenses.
Correct. But because your entire income hits the principal first, even temporarily before expenses are paid, the average daily balance is kept much lower.
Ah, I see. Lower average balance means less daily interest calculation.
You got it. This continuous flow, with all your income working to suppress the principal, allows for incredibly rapid principal reduction.
And that's how you get to those payoff times Switch U talks about, like 5 to 7 years.
That's the mechanism, according to Switch U. It accelerates the payoff dramatically compared to the 30-year slog.
Okay, that makes sense mechanically. But it leads to the next big question, doesn't it? If this is so effective, why isn't it common knowledge?
Right. Why isn't every bank pushing HELOCs as the best way to pay off your house?
Exactly. Switch U offers a pretty straightforward answer, actually, and it lines up with basic business sense.
Let me guess. Profits.
Bingo. Banks simply make significantly more money on traditional 15, 20, or especially 30-year mortgages. All that front-loaded interest over decades, that's a huge profit center.
So naturally, they're going to market and sell the products that make them the most money. Their businesses, after all, trying to maximize returns for their shareholders.
Makes sense from their perspective.
Absolutely. And if we connect this to the bigger picture, it's not really a hidden secret for everyone, particularly not for, say, financially savvy folks or wealthier individuals.
Right. People who maybe have advisors or actively look for more efficient ways to manage their money.
Precisely.
Right.
Our source material points out that people who actively manage their finances have known about and used similar strategies for years, even decades. Millions have used this kind of approach to pay down debt quickly.
So it's not some brand new, untested idea.
Not at all. It's not financial alchemy. It is, like Switch U keeps saying, just math.
Just math.
The numbers tell the story when you apply them to different loan structures. It really boils down to understanding this different financial tool, the HELOC, and how its specific features can be strategically used against your largest debt.
Okay, talking about strategies is one thing, but the real proof, like you said, is in the numbers. Switch U provides a really compelling comparison. They put a traditional 30-year mortgage head-to-head with their Switch Your Mortgage HELOC strategy.
Yeah, and the difference is pretty stark.
Ready to see the actual dollars and cents for a, typical kind of scenario?
Let's do it. Let's break down a hypothetical $250,000 loan, just to illustrate the contrast.
Okay, $250,000. What does the traditional 30-year path look like?
Well, typically you might be looking at, say, a $13,000 down payment right off the bat.
Okay.
Then maybe around $7,500 in closing costs.
Yeah, those add up.
They do.
Yeah.
And potentially another $15,750 in mortgage insurance, depending on your down payment and loan type, spread out over the years.
Right.
But here's the number that really hits home, the big one. The estimated total interest paid over those 30 years.
How much?
Around $206,016.
Wow. Over $200,000 just in interest.
Just interest. So that $250,000 home, the total cost balloons to a staggering $492,266.
Nearly $500,000, almost double the loan amount.
Exactly. That's the dead pledge in action, you could say.
Okay, now pivot. Let's look at the Switch Your Mortgage HELOC approach for that same $250,000 loan.
All right. According to our source, the picture changes dramatically right from the start. You're looking at potentially $0 for a down payment.
Zero down. Okay.
$0 in closing costs and $0 for mortgage insurance up front.
That alone frees up, over $20,000 in cash right there?
Easily. But here's the real kicker, the truly transformative number, the total interest paid using the HELOC strategy.
Okay, what does that drop to?
It plummets to just $42,820.
Wait, from over $206,000 down to about $42,000.
$42,820. That's the estimate in this example, which makes the total cost of that same $250,000 home a much, much more manageable $292,820.
Wow. Okay, so what does that mean in actual savings for you, the homeowner? Let's just put those totals side by side.
You had $492,266 the traditional way.
Right.
Versus $292,820 with the HELOC strategy.
That's a $200,000 difference.
$200,000 saved on that single hypothetical loan. It's massive.
And Switch U actually reports that their clients, on average, see even more savings than that.
Yeah, their reported average is over $285,000 in mortgage interest savings per client.
That's not just like a bit of extra cash. That is genuinely life-changing money.
Absolutely. Money that stays in your pocket. Money you can use for investing, retirement, travel, education, whatever your goals are.
It completely shifts the financial reality of owning that home.
It really does. And the numbers, they are incredibly clear, incredibly compelling. Switch U strongly encourages people, and this makes sense, to plug in their own specific numbers. You know, your actual mortgage balance, your income, your expenses.
Into their calculator, right?
Exactly. Yeah. Into their calculator to get a personalized projection. See how much faster you could pay off your specific mortgage and exactly how much you could save in interest.
Because it's not a one-size-fits-all thing, is it? It depends on your situation.
Precisely. It's about understanding the power of this mathematical principle applied to your unique financial life.
And the cost of... Well, the cost of sticking with the traditional path just because it's familiar.
The cost of conformity, maybe, or just not being aware that these alternatives exist. It can be immense, especially when we're talking about your single biggest debt.
It really underscores the power of just getting educated, doesn't it? Making informed decisions.
Huge power.
Okay, so beyond the math, which is undeniably compelling, the human stories, the experiences of real people who've actually done this.
Yes. Those are incredibly powerful, too. Switch U shares a lot of testimonials from clients who are seeing these huge, really personal shifts in their finances.
These aren't just numbers on a page. They're like real lives being changed.
Absolutely. And what's fascinating is the sheer range of impact you see across different people and different situations.
Give us some examples.
Okay, so there's Joe Jackson. He went from having, get this, 300 months left on his mortgage.
That's 25 years.
25 years. Down to just 50 months remaining after implementing this.
Wow, that's incredible time compression.
Isn't it? Then you have Harry Childs. He saved $158,000 in interest and slashed his payoff time from 23 years down to only 6 years.
23 down to 6. Amazing.
And it's not just, regular homeowners finding this. Even seasoned pros are blown away. Jimmy Kazan, he's a licensed mortgage broker, been in the business over a decade.
Okay, so he knows mortgages inside and out.
You'd think so. He said this strategy just, quote, knocked me on my ass, because it completely changed how he understood mortgage mechanics.
Huh. That's quite an endorsement from someone in the industry.
It really is.
And it's not just single-family homes either. You mentioned different property situations.
Right. Take Olga Leva. She stands to save over $872,200, almost $1 million in mortgage interest across her multiple properties.
Incredible. And it's helping professionals help their clients, too.
Yeah, definitely. Diva Childs, a realtor, mentioned that she now has this powerful solution for clients who are struggling in the tough, traditional mortgage market. She called Switch U a real light bulb moment.
Like it gives her another tool to genuinely help people.
Exactly. And some clients, like Cameron Core, have this kind of profound realization afterwards. He figured out that by not knowing about this sooner, he'd effectively bought 5 houses for the bank just through interest payments over the years.
Oh, man. That really puts the cost of, well, not knowing into perspective, doesn't it?
It absolutely does. And Switch U notes, their clients consistently give them 5-star ratings, rave reviews, comments like mind-blowingly brilliant or phenomenal.
So people are clearly happy with the results.
Seems so. They've also earned Better Business Bureau accreditation, which speaks to their transparency and customer service. And get this, they reported saving their clients over $6.3 million in mortgage interest in just 1 month, back in September 2021. $6.3 million in a single month.
Yeah. So if you connect all the testimonials, the ratings, the sheer volume of savings, it really suggests a significant positive shift for a lot of people who are actively looking for a smarter way to handle their home debt.
Okay. So we've taken a pretty deep dive here into Switch U and this HELOC strategy. We've revealed how it aims to fundamentally transform, how you think about your mortgage and, more importantly, how you actually pay it off.
Yeah, it's all about understanding the mechanics of this different type of loan, the HELOC.
And leveraging its structure, that daily simple interest, the income application.
To save potentially hundreds of thousands of dollars in interest and condense what could be decades of payments into just a handful of years.
It's a powerful concept.
It is. And this deep dive, I think, raises a really important, broader question for you, the listener, to consider.
What's that?
Well, if such a massive financial shift is possible, with something as fundamental as ingrained as your mortgage, what other areas of your financial life might currently be governed by unseen rules?
Or just traditional wisdom that's accepted without question.
Exactly. Or simply a lack of awareness about alternatives that could be challenged, for your benefit.
It makes you wonder, doesn't it? What's the true cost, not just in dollars, but maybe in time, in freedom of not actively educating yourself on every possible option out there?
What opportunities are being missed simply by sticking to the default path?
Something genuinely powerful to mull over, for sure. We really hope this deep dive has given you a valuable shortcut to being well-informed about this specific financial alternative.
And maybe, more importantly, spark some truly impactful aha moments for your own financial journey.
Yeah, food for thought as you look at your own finances.
So if this has piqued your interest, if you're thinking, okay, I need to know more about this, how can people explore it further?
Switch U makes it pretty easy. They offer a free ebook. It goes into more detail about, as they put it, the secrets wealthy people are using right now to get ahead of their mortgages.
A free ebook sounds like a great starting point.
Definitely. It breaks down the strategy more, explains the mechanics, a really valuable resource if you're serious about this.
And what about seeing the potential impact on your own mortgage?
Yeah, they've got that covered too. Switch U has a savings calculator on their site.
Oh, cool.
You can actually plug in your own loan details, balance, interest rate, income, that kind of thing. And it will estimate how much faster you could pay off your specific mortgage using the HELOC strategy.
And crucially, how much interest you might save.
Exactly. It gives you personalized numbers. Seeing that potential savings figure for your own situation can be really, really eye-opening.
A powerful tool indeed.
And it leads to that final thought, which you often leave people with. They ask you to consider the cost of not enrolling. Basically, think about how much more it might cost you in time and in money and interest to just stick with the status quo, to not implement a strategy like the HELOC one. The numbers, as we've discussed, they don't lie. They really do point towards a faster way to financial freedom.
And maybe, more importantly, spark some truly impactful aha moments for your own financial journey.
Yeah, food for thought as you look at your own finances.